What if you could build a portfolio that pays you over $2,800 a month in passive income, or grows into nearly $1 million, all while investing less than the price of lunch each day? Sounds impossible? It's not. Most people make investing way harder than it needs to be. They chase hot stocks, follow random tips online, or try to time the market, and almost always end up stressed, second-guessing, and underperforming. But what if building wealth didn't have to be that complicated? What if just 4 ETFs, yep, 4, could give you everything you actually need for long-term growth, passive income, and peace of mind? I call it the Wealth Quadrant System, and once you understand how it works, you'll see why it's such a game changer. In this video, I'm going to walk you and Josh through the entire Wealth Quadrant System, step by step. You'll see how just 4 ETFs can give you full market exposure, protect your portfolio from downturns, drive massive long-term growth, and one of the ETFs even generates over $200,000 a year in passive income. In the end, I'll show you how to combine an ETF from each quadrant and build 2 complete portfolio strategies, one for income that pays over $34,000 in annual dividends, and one for growth that can reach close to $1 million valuation, all while investing just $9 a day. But before we dive into the 4 ETFs themselves, let's break down the system behind it, and why this approach could finally give you the clarity and confidence you've been looking for. Imagine trying to build a house without a plan. You might get a few walls up, maybe even a roof, but without structure, it won't hold up. Your portfolio works the same way. It needs a solid blueprint, one that balances strength, growth, cash flow, and future potential, without leaving you guessing. That's what the Wealth Quadrant System is all about. It breaks investing into 4 key needs: a strong foundation, consistent resilience, high-powered growth, and reliable income. Each of these plays a different role, and when they're all working together, your portfolio stays balanced, steady, and ready for anything. Let's break that down a little more. First, you need a foundation, something that gives you exposure to the entire market. Big companies, small companies, every sector, not just the popular ones. This gives your portfolio natural balance and spreads out your risk without you having to think about it. Then comes resilience, the layer of large dominant companies that have been through cycles, crashes, and comebacks. These are the businesses that hold steady when things get rocky and keep pushing forward when the market runs. Next, there's growth, the engine that pushes your portfolio further. These are the companies investing in innovation, expanding fast, and chasing the future. They're more volatile, sure, but they also bring the potential for serious upside. And finally, income, the cash flow that keeps things moving even when the market doesn't. These are companies that pay you just for holding them, and when you reinvest that income, that's where the compounding magic really kicks in. To make it even easier to track, I'm going with ETFs. Now you might say, why ETFs and not individual stocks? The answer to this is simple. It's instant diversification, instant balance, and it cuts out the guesswork. There are ETFs that cover the entire market, others that focus on specific sectors like tech or energy. Some are built for income, some for growth. But the point is, you're not putting all your eggs in one basket, and you don't have to watch the market like a hawk to keep up. Now, if ETFs are so great, why do so many people still feel overwhelmed? Because there's too much noise. Online, you'll hear 1,000 different opinions: growth versus value, small cap versus large cap, dividend versus momentum. Every influencer has a different strategy, and suddenly you've got 20 tabs open, comparing charts, wondering if you're already too late. That's analysis paralysis, and it's more common than you think. So here's a better way. Instead of trying to outsmart the market, you build a portfolio of 4 time-tested ETFs. They're diversified, they're proven, and they're designed to work together. That way you stop second-guessing, stop reacting to every headline, and finally get what most investors are missing: peace of mind and a clear plan you can stick with. And once you have that clarity, you'll also be able to spot the traps that most people fall into, like chasing big dividends or trying to pick the next breakout stock. Let's talk about why those strategies so often backfire. The dream of living off dividends, getting paid while you travel, relax, or just live your life, sounds amazing, but most people overestimate the income and underestimate the risk. High-yield stocks might flash big numbers, 6%, 8%, even more, but usually there's a reason. Maybe the stock price tanked, maybe the business is struggling, and if profits dip, that juicy dividend can vanish overnight. Even if it doesn't, a sinking stock price can wipe out the value of your investment. Then there's stock picking. Everyone wants to find the next Tesla or Apple before it explodes, but even the pros, with full teams of analysts and all the data in the world, still fail to beat the market consistently. For regular investors, it's like throwing darts blindfolded. You might hit a winner once in a while, but more often than not, you miss, and one bad pick can wipe out the gains from 5 good ones. That's why ETFs exist. They let you own the winners, avoid total wipeouts, and grow steadily without betting your future on a single stock. Now here's the smart part. Each ETF we're about to look at fits perfectly into one of these 4 wealth quadrants we saw a minute ago: foundation, resilience, growth, income. And together, they don't just balance each other, they actually make each other stronger. I'm not throwing darts here, we're building something with purpose. And it all starts with the foundation, an ETF that gives you ownership in thousands of companies across the US economy, all in one simple move. And that is Vanguard Total Stock Market Index Fund ETF shares with a ticker symbol VTI. This ETF is like buying a tiny piece of nearly every company in America all at once. It holds over 3,600 different stocks, covering everything from tech giants to small-town manufacturers. Big players, small caps, every sector, it's all in there. This is your foundation because it doesn't try to predict winners. It just owns the whole field. And that kind of exposure means you don't have to worry about which sector is hot or which trend is fading. When tech is down, maybe healthcare is up. When large caps stall, small caps pick up the slack. It's built-in balance, and that's exactly what a solid foundation should give you. At the top of the fund, you'll find names that dominate the global economy. Apple with 6.19%, Microsoft 5.17%, Nvidia 4.66%, Amazon 3.36%, Meta 2.34%, Berkshire Hathaway 1.75%, Alphabet 1.67%, and Tesla 1.31%. These are household names with deep economic moats, and they make up a sizable chunk of VTI's exposure. But beyond that, you're also holding thousands of mid-cap and small-cap companies, the next generation of market leaders in the making. That kind of breadth brings built-in balance. When tech cools off, financials or healthcare might step in. When large caps slow down, small caps can take the lead, and through it all, you stay invested across every twist and turn. Now let's talk numbers. In the past year alone, VTI returned 11.27%, which includes both price gains and dividends. Its 5-year total return sits at 95.86%, and across 10 years, it has grown by 154.73%, more than tripling an investor's money. All this is done with an ultra-low expense ratio of just 0.03% in the industry. That's free, which means more of your returns stay with you. VTI has a current dividend yield of 1.37%, a dividend growth rate of 6.73%, and an average annual share price appreciation of 9.73%. Now, if you or Josh, let's say, invest $9 a day into this ETF, after just 1 year, you would have invested around $3,285. But stay the course, and by the 10-year mark, that number grows to approximately $55,000. Keep going for 20 years, and your investment would reach $204,000. And if you're truly playing the long game, 30 years of consistent contributions and reinvested dividends, you're looking at an impressive portfolio worth about $600,000. By then, your yearly dividend income would hit $3,100. That's why VTI is your foundation. It's broad, it's boring in the best way, and it's always working steadily over the long run. Now, foundations are great, but you also want something with more focus, something that locks in on the biggest, strongest companies and gives you resilience when the market gets shaky. That's where the next piece of the quadrant comes in: resilience. In the end, I'll show you how to combine an ETF from each quadrant and build 2 complete portfolio strategies, one for income that pays over $34,000 in annual dividends, and one for growth that can reach close to $1 million valuation, all while investing just $9 a day. Back to the quadrant system. For resilience, I have Vanguard S&P 500 ETF, or VOO. VOO tracks the S&P 500, a collection of America's 500 biggest and most profitable companies. These are firms with solid earnings, dominant market positions, and a long history of pushing the economy forward. When you invest in VOO, you're not just betting on the market, you're backing the leaders of it. VOO gives your portfolio a layer of strength. These companies aren't just surviving, they're leading. They've been tested through market crashes, recessions, and rallies. When the economy dips, these are the ones still hiring, still innovating, still paying dividends. It's this kind of stability that gives your portfolio resilience, that ability to take a hit and keep going. You're not gambling on trends here, you're backing the giants. Let's talk about who you actually own inside this fund. VOO's top holdings are a lineup of giants: Apple with 7.03%, Microsoft 5.58%, Nvidia 5.59%, Amazon 3.78%, Meta 2.66%, Berkshire Hathaway 2.06%, Alphabet 1.9%, Broadcom 1.65%, and Tesla 1.53%. Together, these companies make up over 33% of the ETF, meaning this fund leans hard into the names that are shaping technology, finance, and the future of the economy. That means VOO gives you powerful exposure to technology, healthcare, consumer, and finance without you having to pick individual stocks or time the market. It's automated, diversified, and ruthlessly efficient. And the numbers to back it up: over the past 1 year, VOO returned 12.19%. Over 5 years, it's up to 99.81%. In over 10 years, it is compounded by an impressive 168.52% in price return alone. And speaking of dividends, VOO currently yields 1.36%, distributing about $6.70 per share annually with a 0.03% expense ratio. That means you're getting elite exposure at nearly zero cost. It's efficient, stable, and built to compound over time. Also, it increases those dividends by 6.56% on average each year, and to top it off, it has an average annual share price appreciation of 10.32%. Now, let's break down if you started investing $9 a day into this ETF. Your portfolio at the end of the first year would be valued at $3,285. Simple enough. But fast forward, and by year 10, it would grow to $56,000. By year 20, it's projected to reach $216,000. And after 30 years, you'd be sitting on approximately $659,000. Out of that, more than $530,000 would come from price appreciation, with another $31,000 from reinvested dividends, making $561,000 total value added to the portfolio. By that time, you'd be earning about $2,700 annually purely from owning one ETF. What makes VOO such a powerful complement to VTI is that it sharpens your exposure. Where VTI gives you everything, VOO leans into the winners, and that extra focus can give your portfolio more staying power in tough markets. But resilience is just one side of the story. Now that we've got the foundation and strength in place, it's time to turn up the heat. Let's talk about what drives serious portfolio growth and how the right ETF can supercharge your long-term returns. For this, I have iShares Russell 1000 Growth ETF with a ticker symbol IWF. This ETF focuses entirely on growth, not slow and steady, but fast-moving, high-conviction innovation. It tracks the Russell 1000 Growth Index, which means it holds large-cap companies that are aggressively reinvesting in themselves, building new products, expanding into new markets, and leading the future in tech, healthcare, and beyond. IWF holds the big names like Apple, 11.24%, Microsoft 10.6%, Nvidia 9.24%, Amazon 6.42%, Meta 4.03%, Alphabet 3.44%, Broadcom 3.26%, Tesla 3.09%, and Eli Lilly 2.7%. These companies are the innovators, the disruptors, and they're not sitting still. They're driving digital infrastructure, artificial intelligence, cloud computing, and next-gen healthcare. More than half of the fund is concentrated in these top 10 companies, so it's definitely more aggressive than VTI or VOO, but intentionally so. IWF is designed to tilt your portfolio toward innovation and future potential. That concentration isn't without risk, but it's exactly what gives IWF its edge. Over the past 10 years, its price return has been 273.68%, which means the share price has nearly quadrupled. Over 5 years, the price return is 122.14%, and in just the past year, it's up 15.75%. That's not just strong, it's elite performance in the growth ETF space. Even during turbulent stretches, IWF has shown resilience, bouncing back and continuing to climb. If you're looking for long-term appreciation driven by cutting-edge companies, IWF checks that box decisively. It doesn't pay much in income. The current yield is just 0.48%, but this fund isn't about dividends, it's about scale. It's for people who understand that wealth isn't built from cash flow in the early years, it's built from appreciation, then converted to income later. IWF has a current dividend yield of 0.48%, a dividend growth rate of 3.21%, and an average annual share price appreciation of 14.03%. So what happens if you invest $9 a day in this ETF? After 1 year, you would have invested $3,285. That's your initial seed, but give it time and watch what happens. In 10 years, that same consistent investment would grow to about $64,000. Stick with it for 20 years and you'd be looking at nearly $305,000. And if you stay the course for 30 years, your portfolio would climb all the way to around $1.2 million. What's incredible is that almost every dollar of that growth comes from capital appreciation, not income. And that's the point. IWF adds a forward-leaning, fast-moving layer to your wealth quadrant. It brings scale and ambition, and it pushes your long-term returns further than stability alone ever could. But it has its risks as well. In the end, I'll show you how to combine an ETF from each quadrant and build 2 complete portfolio strategies which reduce risk and still have the potential to reach close to $1 million valuation. IWF is high growth, and high growth often means low income. And not everyone wants to wait decades for their portfolio to start paying them back. That's why the next ETF is here, to deliver real, reliable income now and help you build cash flow you can count on. And checking the income quadrant of your portfolio, for this quadrant, I have Schwab US Dividend Equity ETF with a ticker symbol SCHD. If there's one ETF in this portfolio that truly earns the label cash flow machine, it's SCHD. While IWF brings speed and VTI brings scale, SCHD delivers steady, rising income with a complement to a rock-solid foundation. This ETF is all about one thing: consistent, growing cash flow. And unlike high-yield funds that chase risky payouts, SCHD is built on quality. It only holds companies with strong balance sheets, solid cash flow, and a proven history of rewarding shareholders. These aren't flaky high-yield traps, they're real businesses with staying power. What makes SCHD different is its strict selection process. To be eligible, a company must have a market capitalization of at least $500 million, a minimum average daily trading volume of $2 million, and a history of paying dividends for at least 10 consecutive years. Once these criteria are met, the fund evaluates companies based on 4 equally weighted factors: free cash flow to total debt ratio, return on equity, indicated annual dividend yield, and 5-year dividend growth rate. This comprehensive approach ensures that only financially robust companies with a strong commitment to returning value to shareholders are included. The final portfolio comprises 100 stocks, with individual holdings capped at 4% to 5% and sector exposure limited to 25% to maintain diversification. This meticulous selection process aims to provide investors with a stable and growing income stream, making SCHD a compelling choice for those seeking reliable dividend income. Inside the fund, you'll find companies like Coca-Cola holding 4.44%, Verizon 4.41%, ConocoPhillips 4.3%, Lockheed Martin 4.28%, Home Depot 4%, AbbVie 3.95%, and Amgen 3.94%. These are firms that have weathered economic cycles and kept rewarding shareholders through it all. SCHD is diversified across sectors, with heavy weightings in consumer defensive, energy, healthcare, industrials, and financials. These industries tend to hold up well during economic downturns, which is why SCHD often performs with surprising resilience. And the numbers back it up. Over the past 1 year, SCHD returned 1.18%. Over 5 years, it's up 58.52%. In over 10 years, it is compounded by an impressive 94.43% in price return alone. And speaking of dividends, SCHD currently yields 4.04%, distributing about $1.04 per share annually with a 0.06% expense ratio. That means you're getting high-quality dividend exposure with almost no drag from fees. It's efficient, income-rich, and built to do one thing extremely well: pay you year after year. It also has one of the most solid dividend growth histories thanks to its strict selection process. Its dividend growth rate stands at a sound 11.3%, and from the price history, you get an average annual share price appreciation of 6.83%. Now, let's look at what happens if you commit to it long term. If you invested $9 a day into SCHD, your portfolio could grow to nearly $58,000 in 10 years. After 20 years, that number would hit around $291,000, and by year 30, you're looking at a portfolio worth approximately $1.69 million. And since it's a dividend-focused ETF, by the 30-year mark, it will be paying around $200,000 a year in dividends alone. That's over $16,600 per month, all from reinvested cash flow that kept compounding year after year. More than $1,008,000 of that total value would come just from reinvesting those dividends, and $588,000 from capital appreciation, adding total value to the portfolio of $1,596,000. SCHD doesn't chase moonshots. It's not trying to double overnight, but it delivers something that's just as powerful: stability, sustainability, and the kind of income that can give you financial freedom. Now you have an ETF for foundation, resilience, growth, and income. But here's the thing, depending on what stage of life you're in or what kind of investor you are, there's more than one way to use this setup. You can take the same building blocks and shift the weight to match your goals. Some people want their portfolio to start paying them sooner. They're thinking about income, maybe even early retirement. Others are laser focused on growing their money as fast as possible and letting it compound for the long haul. So let me show you two real strategies you can use with these same ETFs. One is all about dividend income, the other leans hard into growth. Both are smart, both are simple, and both are built with purpose. Let's start with the dividend-focused portfolio. This one is designed to pay you back with real income when you retire. This portfolio is for investors who love the idea of getting paid to own great companies. It's built to generate solid cash flow, but still give you long-term growth. You're not just collecting checks, you're growing your wealth too. So here's how you set it up. You'd put 70% of your money into SCHD. That's the workhorse, a high-quality dividend ETF filled with companies that don't just pay dividends, but keep raising them. Then you have the remaining 30%, 10% each to VTI, VOO, and IWF. That gives you full market coverage, large cap stability, and a little extra growth potential, without overcomplicating things. Now let's talk about how we figured out the income this portfolio can actually produce. It's not guesswork, it's math. I looked at the dividend yield of each ETF in the portfolio. So, SCHD might be paying around 4%, while VTI is closer to 1.3%, VOO about the same, and IWF under 0.5%. Then, based on how much of the portfolio each one takes up, I calculated the average, but not a simple average, a weighted one. When we run those numbers, the overall dividend yield for the whole portfolio comes out to about 3.15%. Okay, let's break this down like we're figuring out how to calculate your portfolio metrics when you don't invest equally. In your dividend-focused portfolio, SCHD makes up the biggest chunk, 70%, while VTI, VOO, and IWF each make up 10%. Now, each of these ETFs has its own flavor when it comes to dividend yield. SCHD has a strong one at 4.04%, while the others are much lighter. VTI is 1.37%, VOO is 1.36%, and IWF is just 0.48%. If you just added those numbers up and divided by 4, you'd get a simple average, but that wouldn't make sense here. You're not putting equal amounts into each one, you're putting way more into SCHD, so its impact should be way bigger in the final number. So here's what you do instead. You multiply each ETF's dividend yield by how much of the portfolio it represents. For SCHD, that's 70% or 0.7 times 4.04%, which gives us 2.828%. Then we do the same for the others. 0.1 times 1.37% equals 0.137%, 0.1 times 1.36% equals 0.136%, 0.1 times 0.48% equals 0.048%. Now we just add all of those up. 2.828 plus 0.137 plus 0.136 plus 0.048 equals 3.15%. And that's your real total dividend yield for the whole portfolio. I did the same kind of thing for dividend growth, looking at how quickly each ETF has increased its payouts over the past decade. SCHD's been crushing it with over 11% annual growth. VTI and VOO have been solid too, and even IWF contributes, though it's more of a capital appreciation play. When you weigh those based on how much each ETF contributes to the mix, you get a dividend growth rate of about 9.56% per year. Now here's where it gets exciting. I ran the numbers on what this portfolio could become over time, assuming you invest $9 a day every single day and reinvest all the dividends back into the portfolio. After the first year, you'd have about $3,285 invested. Stay the course, and by year 10, you're looking at $57,000. 2 decades in, and it will grow to $234,000. And if you stick with it for 30 years, you will be sitting on $826,000. By that 30th year, this portfolio would be paying you about $34,100 every single year. That's over $2,800 a month. If you add it all up, the capital growth plus all the reinvested dividends, you're looking at a total value added of $727,500 over those 3 decades. About $476,500 comes from price appreciation, and the rest, a solid $251,000, is from reinvested income. But let's say you're not looking for income right now. Maybe you've got time on your side and you're in full growth mode. You're not thinking about cash flow yet. You're focused on building a big, powerful portfolio that can give you options later. That's where the growth-focused portfolio comes in. This one's built for people who aren't worried about income today. Maybe you're in your 20s, 30s, even 40s, and you're thinking long-term. You've got time. You want that snowball to get as big as possible before you start living off it. So instead of focusing on dividends, this portfolio leans into fast-moving, high-growth companies. You're still diversified, but the goal here is simple. Grow your money as much as possible, as fast as possible, with smart, broad exposure. Here's how that setup works. You take 70% and put it into IWF. That's your high-growth engine. Then, to keep things balanced, you add 10% into VTI, 10% into VOO, and 10% into SCHD. VTI gives you a piece of everything in the market. Just like for the dividend growth, you can find the investing metrics for the growth portfolio using weighted average metrics. If you allocate investment this way, the overall portfolio will still have a yield. It's just low, around 1.02%. And that makes sense. This portfolio is focused on appreciation, not income. Same goes for dividend growth. Since we're not building around SCHD this time, the average growth rate is lower, about 4.71% a year. It's there, but it's not the priority. Where this strategy really shines is in share price growth. When you look at how fast these ETFs have grown in value, especially IWF, the numbers are seriously impressive. Weighted together, this portfolio's average annual price appreciation is around 12.51%. That's where the firepower comes from. So let's run the same $9 a day scenario and see what this thing can do over time. After year 1, just like before, you would have gotten $3,285 invested. But hang in there, and by the 10-year mark, you will already surpass the dividend-focused portfolio, valued at around $61,000. Stay consistent, and by year 20, you would hit $264,000. Push all the way to 30 years, and this portfolio could grow to around $927,000. That's nearly $1 million portfolio. And remember, that's without chasing high yields or trying to time the market, just consistent investing, reinvesting everything, and letting the math do its thing. Now, the dividend income from this strategy? It's not much. By year 30, you're getting about $794 a year. That's around $66 a month. But that's the trade-off. You're not collecting big checks today. If you look at the total value added over those 30 years, it's even bigger than the dividend strategy. You're looking at $829,000 in total gains, with $817,000 of that coming purely from price growth. Only about $12,000 came from reinvested dividends. It's a totally different approach, but the logic is just as sound. Now the real question becomes, which of these feels more like you? Because neither is better or worse, they're just different tools for different goals. And once you know what you're aiming for, choosing the right one becomes a whole lot easier. Want only dividends? Click the video on screen to see how much you need to invest in SCHD to retire in 30, 20, or 10 years from now.